Hi, this is Mike Larson from Money and Markets TV. These are some of the most volatile markets that I've ever seen. Over the past 4 days, the Dow has been down 630 points, up 430 points, down 520 points, and up 420 points. And that's not all. We've seen $50 to $70 daily moves in gold, 8-cent moves in the value of the Swiss franc, and a $25 collapse in the price of oil in just a few days. It's enough to make your head spin. But folks, I'm not about to run and hide. I'm embracing that volatility. And I recommend you do too, because volatility like this presents some of the biggest profit opportunities of our lifetimes. By now, you should be aware of my bearish, big picture fundamental outlook. I've repeatedly warned you to dump most of your stocks and all of your REITs, as well as buy gold and inverse ETFs that rally when stocks fall. I told you that this multi-pronged strategy would help prepare you for a double-dip recession, a second top in real estate, and the second phase of this great credit crunch. And sure enough, each and every one of those strategies is now paying off in spades. For example, let me tell you what I did after Monday's historic collapse, when fear gauges surged, banks imploded, and everything from junk bonds to REITs tanked. I took profits on several positions that I put on before the crisis, and not small ones either. Subscribers to my services enjoyed gains of as much as 100% in 2 months and more than 31% in 10 days, depending on the investment vehicle and strategy. So why did we take so much exposure and so many profits off the table? Because I knew we were finally seeing whiffs of real panic, and because my technical indicators suggested we were due for a short-term but potentially serious bounce. So what happened? On Tuesday, the Federal Reserve came out and pledged to keep interest rates low through mid-2013. That phrase alone ignited a Dow rally of several hundred points from the intraday low. Now, never mind that the Fed pledge was well telegraphed and one of the least powerful of all the options that policymakers had on the table. It still worked from Ben Bernanke's perspective, which I'm sure was to goose the stock market after its epic collapse. But because my subscribers took profits before that happened, they weren't really hurt. They sailed right through the volatility. And better yet, they now have fresh ammunition to use when the next oversold rally strikes. Now you might be asking why I'm walking you through this trading play-by-play. Well, it's because if you want to protect your wealth and profit in these kinds of markets, you have to understand how to surf major volatility waves. It's absolutely imperative not to just buy and hold, but rather to add inverse positions on rallies and take profits into declines. That's what worked during the last crisis, and it's what's going to work this time too. I say that because conditions are very similar now to what we saw then. Only now, the locus of the credit crisis is sovereign bonds, countries, and currencies, as opposed to the private banks, brokers, and home builders that collapsed last time. Finally, for those of you who aren't comfortable with the faster trading pace, let me just say this. You do not see these kinds of hugely volatile moves in bull markets. You see them in bear markets, like 2000 to 2002 and 2007 to 2009. I believe that's what we re-entered this summer, and that's what we won't exit again for a long, long time. So invest and plan accordingly. I'm Mike Larson for Money and Markets TV. Thanks for watching.